Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. On today's show, we're talking about a situation that confuses a lot of investors. How can the same property have two different underwriting models, and how can both of them be correct? The answer comes down to perspective. A lender is underwriting a property for one purpose, and an investor is underwriting a property for a different purpose. Those two objectives overlap, but they're not identical. Let's use a real-world example. There's a number of state and local programs around the country that offer some form of property tax abatement for qualifying projects. Those economics can be meaningful. Suppose the property would normally pay, let's say, $1 million a year in property taxes. Under the applicable program, the actual tax expense might be reduced by $700,000 a year, down to $300,000. That's a substantial saving that, when you take that into account, materially affects the value of the building. But there's a wrinkle. The tax abatement has to be approved each year. Maybe the project has met the qualifications for 10 years in a row, and maybe the operator has every intention of continuing to satisfy those requirements. There should be no reason to believe that the approval will disappear. But still, technically, the approval is annual. Now put yourself in the shoes of the lender. The lender might be making a 25 or 30 or 35-year commitment to the loan. It's fully amortized. The credit committee has to ask a very specific question. What income can we reliably count on when determining the borrower's ability to repay the loan over the entire term? The lender might decide that because the tax abatement requires annual approval, they're not going to recognize the benefit in their underwriting. From their perspective, it's perfectly rational. They're not trying to predict the most likely outcome. They're establishing the amount of permanent debt they're willing to put at risk. Those are different questions. Now consider the investor. The investor needs to determine what the property is most likely to actually earn. If a property is consistently qualified for the tax abatement, the conditions for qualification are well understood, the ownership intends to continue complying with the conditions, then ignoring that tax abatement entirely would produce a financial model that's actually less realistic. And this is where I believe you need two different underwriting models. The first is the lender underwriting model. That model reflects the lender's rules, and if the lender refuses to recognize the tax abatement, then you calculate your debt service coverage using the higher property tax expense. That calculation determines the maximum loan proceeds. There's no point arguing with the spreadsheet. Those are the lender's credit policies, and those are the rules that govern the loan amount. The second model is the investor underwriting model. That model should reflect the operating assumptions you believe are most likely to occur. If you have strong evidence the property will continue to comply and qualify for the abatement, then the investor base case should include that benefit. Now, notice the language I'm using. I'm calling it the base case. It's not a guaranteed case. It's not a worst case. Good underwriting should distinguish between what is probable and what's certain. That annual approval does represent some risk, even if it's small. Investors, of course, need to understand that risk. You might therefore run another sensitivity analysis showing what happens if the property loses that tax abatement. What does the cash flow look like? What happens to distributions? Can the property still service its debt? What happens to its value? Those are, of course, important questions. But recognizing a risk is very different from pretending the most probable outcome doesn't exist. That distinction matters because investors sometimes make the mistake of assuming that the lender's underwriting represents the definitive economic truth about a property, and it doesn't. The lender's underwriting is designed primarily to protect the lender. They might give rents a haircut. They might increase vacancy assumptions. They might exclude certain types of income. All of those policies could make perfect sense from a credit perspective, but your job as an owner is different. You need to understand how the property is actually going to perform. In fact, having more conservative lending underwriting can sometimes strengthen the investment. If the lender's methodology results in a smaller loan, then the project will have less leverage than the investor model might otherwise support. That does require more equity, which, at least on paper, might reduce the returns, but it also means greater resilience. I'd rather have a property that outperforms the lender's underwriting than one that needs every optimistic assumption in the spreadsheet just to survive. So I wouldn't just show investors the lender model and call it the operating forecast if that's not how you intend to operate the property. At the same time, I wouldn't show investors the most favorable economic model without explaining the assumptions that create the difference. You definitely want to show both. Here's the lender case, here's the investor case, and here's why they differ. A financial model is not supposed to produce one magic number that tells you whether a property is a good deal or a bad one. The purpose is to understand the range of possible outcomes what drives those outcomes, and where the risks are actually embedded in the assumptions. The lender might underwrite according to policy, and the investor should underwrite according to economic reality and determine the best risk-adjusted returns. The sophisticated operator and the sophisticated investor need to understand both. As you think about your own projects, take a close look where the lender underwriting and the investor underwriting diverge. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.